rates, suddenly these money market funds will be less attractive. And people will get frustrated, like I'm getting less interest now while the market's going up, right? And they will start to pull their money out of the money market funds and put it back into the stock market. So that would add more fuel to the market. You understand? Are you still with me, everyone? All right, so all these are things that can go right. Can I now tell you what can go wrong? At both perspectives, right? So what can go wrong? Let's look at the bearish argument right now. Okay, so there are altogether 6 main things that could go wrong. Of course, everything can go wrong. Okay, number 1, the first argument is that economic growth has been so strong that it has to slow down. Okay, so you can see that everyone predicted a recession last year. Instead, last year, 2023, we had record GDP growth, right? In fact, we just had the Q4 GDP growth coming at 3.3%. So what the bears argue is that, you can't have this growth indefinitely, right? After a strong growth, you have to slow down, which I don't disagree with. So I won't be surprised that the first half of this year, economic growth will slow down, simply because after a strong growth, that temporarily could pull the market down as growth slows in the first half, which I'm hoping it would, because then I can get a chance to buy more shares of my magnificent companies, right? If it keeps going up, then I can't buy any more shares. I want to buy more shares. I need it to come down to buy more shares. I don't want it to keep going up. Okay? Number 2 is data shows that US consumers have record high credit card debt. That their credit card debt is at all-time high, right? So people argue, credit card debt all-time high, they can't spend money, right? Yeah. But on the other hand, their income is still growing. So there are many moving parts, okay? Third, economic leading indicators have been trending down. I'll talk more about it in a while, okay? Number 4, and this is a good argument. So what people are saying is that the Fed raised interest rates like crazy in 2022, but there's no recession because the impact of the interest rate hike has not been felt yet, because it's a delayed effect. So what they're saying is that now in 2024, finally the effect of the high interest rates will hit the economy, and that will hit the economy into a recession. Could this happen? Of course, everything is possible, right? There's always something that we could worry about, right? Next, number 5 is the inverted yield curve. The yield curve remains inverted, and of course, if you look at history, 70% of the time, an inverted yield curve leads to a recession. All right? So that's another reason to be worried. Of course, the last reason is, what if there's an escalation of geopolitical issues? What if the Ukraine war spreads to Europe and NATO gets involved and Poland gets involved, right? What if, what's the other war again? Hamas and Israel. What if that spreads to Iran, and then Iran bombs America, right? Anything can happen, right? So of course, could this derail the bull market? Yeah. There's always something to worry about, okay? So, for you bears out there, here's some bear porn, okay? So, some charts for you to see, make you bears happy, right? So, yep, record high credit card debt. But again, offset by increasing wages and household wealth at all-time high as well, right? Next, bears also argue that the leading economic indicators have been trending down. What are leading economic indicators? Let me kind of like zoom in for you here. Okay. So the one in red is the leading economic indicators. And historically, people believe that these indicators are a leading indicator to the economy. They tell you what is likely to happen to the economy in the future. And it has been going down. It has been going down now for more than 12 months. So people are saying, hey, if the leading economic indicator is going down, right, like this, like this, like this, then we will definitely get a recession, right? Because, but then you've got to ask yourself, what are the components of the leading economic indicator that have been pulling it down? So let's take a look over here on this chart, okay? So the leading economic indicator is made up of 1, 2, 3, 4, 5, 6, 7, 8, 9 components. And the component that is pulling it down the most is consumer expectations. That means consumers are, through surveys, they're expecting a recession. All right? So in other words, it is just the consumer expectation that is causing this down. Second is ISM new orders. ISM is the same as PMI. So the PMI has been negative. But this one has been resolved because I showed you, right, that the PMI just turned positive. So this one no more. Okay? Next is the interest rate spread. That's negative. What is this? This is the inverted yield curve. So in other words, is the inverted yield curve falling PMI and consumer expectations falling, that is causing the leading economic indicators to fall, right? So personally, I don't think that that would necessarily guarantee a recession, okay, because of the reasons which I talked about, okay? Are you enjoying this economics lesson, by the way? Some of you say, I hate economics, it's so boring. Can you tell me what to buy now? I'm coming to that, right? Hold on, I'm coming to that. Give me 5 more minutes. 5 more minutes of boring economics. Let's talk about the yield curve inversion. Now, first of all, let me explain the yield curve for those of you who are not too familiar with the yield curve. Oh, give me a second, right? Okay. So what is the yield curve? Oh, thank you, loving it. That's great. I'm glad it's not boring. Okay. Now, what is the yield curve? The yield curve basically shows you the different interest rates you get when you lend money to the US government at different maturity dates. Okay, so for example, let me kind of like plot a graph for you guys here. So this is the interest rate, or yield. Interest rate and yield is the same thing, okay? And this is the maturity of the bond. So let me ask you, if you were to lend money to the US government for 3 months versus lending money to the government for 10 years, which one would you demand a higher interest rate? 3 months or 10 years? 10 years, right? Because if you're lending money to the government for 10 years, you're locking in your money for longer, you demand a higher interest rate, correct? And if you're lending money for only 3 months, you don't mind a lower interest rate, right? This is called a normal yield curve. A normal yield curve means the longer you lend money to the government, the longer the bond, the higher the interest rate, right? That's called a normal yield curve. But now, okay, let me write this down. This is called a normal yield curve. Normal yield curve. Okay? But now we have an inverted yield curve right now. Let me draw this. Three-month bond and 10-year bond. Oops, 10-year bond. So right now, if you buy a 3-month bond, that means you lend money to the US government for 3 months, you are getting about 5.3% interest. Okay? But if you buy a 10-year bond, you're getting 4% interest. So this is called a inverted yield curve. Inverted yield curve. Now, historically, listen very carefully, historically, when the yield curve is inverted, it predicts a recession. It predicts a recession. Now, you've got to ask yourself, why? Why does it predict a recession? Okay, the reason is this. Now, historically, a yield curve becomes inverted when the long-term interest rate drops. Okay, that means this rate drops below this rate, it causes the inversion. Now, why does the 10-year rate drop? It drops when the bond price increases. When the 10-year bond price increases. Now, remember, bond price moves opposite of the yield. When bond price goes up, okay, now if you don't understand this, please watch my videos on explaining treasury bonds, right? It's a whole video in it, right? But just for now, just remember, when bond price goes up, yield goes down. Bond price goes down, yield goes up. It's always the opposite, right? Now, so what causes bond prices to go up? Because people are buying bonds, right? So historically, when do a lot of people buy bonds? People buy bonds when they expect a recession. When they think, oh my God, recession is coming. And a recession, if they think a recession is coming, they want to put their money in safer things. And so they sell stocks and they buy bonds, right? So when they buy bonds, what happens? The bond price goes up and the yield drops, causing the inversion. That's why, historically, it predicts a recession. Okay? But this time is totally different. Because this time, the reason the yield curve inverted was not because the long-term yield dropped. No! In fact, the long-term yield went up. People were selling. Bond price go down, yield goes up. But the reason for the inversion is because the Fed raised short-term interest rates faster than the 10-year yield going up. So in other words, the 10-year yield did not go down, it went up. But this went up more than this. That's what caused the inversion. So what I'm saying is that the inversion this time is caused by something totally different from all the previous inversion. That's why there's no recession. Or you can argue there was a recession, but it was a rolling recession. Okay? So that's why, in this case, the freaking yield curve inversion is not as predictive as it was in the past because of a different cause of inversion. Now, then some people will say, but Adam, if you look at this chart, let me make it bigger for you, right? This chart shows you the 10-year yield minus the 3-month yield, right? 10-year minus 3 months. So if it's above 0, that means it's the 0, that means it's the yield curve inversion. Now, some of you will remember me telling you that it is not the inversion, but the uninversion that then the recession will come, right? So can you see it dropped below 0, uninversion, recession. Recession is in gray, right? Drop below 0, inversion, uninversion, recession. Inversion, uninversion, recession. So every time it uninverts, a recession seems to follow. So some of you would then say, but Adam, are you saying that once it uninverts, then a recession will follow? Historically, yes, but I think this time maybe not. Okay, let me explain my theory. This is Adam's theory. Now, Adam is not an economist. Okay, Adam is just a normal guy. My theory is, now again, what will cause the yield curve to uninvert? what will cause the yield curve to uninvert is when the Fed cuts interest rates, right? So when the Fed cut this interest rate, when they bring this down, when they cut interest rates, then this will uninvert. It will then uninvert. Okay? Now, on social media, on YouTube, there are a lot of YouTube gurus that say when the Fed cuts interest rates, it will cause a recession. That is the most stupid thing you can believe in. You must remember that historically, whenever the Fed cuts interest rates, there's a recession. But it's not the cutting of interest rates that causes a recession. It is the recession happen and the Fed cut interest rates to stimulate the economy out of recession. You follow what I'm saying? Whenever you took a shit, you read the newspapers. Or now you play with your phone, right? Does it mean that the newspaper caused the shit? No, the newspaper didn't cause the shit. The shit was caused by something else. But it's just that whenever you had a shit, you read the newspaper. Okay? So, if the Fed cuts interest rates because they want to save the economy, then yes, cut rates is related to recession. But this time, if the Fed cuts interest rates because they feel that inflation is already low enough and there's no recession, then the cutting of rates doesn't cause a recession. Or the reinversion doesn't cause a recession. Did I just confuse you guys more? Or you understand what I'm talking about? Okay, never mind. If you don't understand, it's okay. Someone's sleeping already. Oh my God, I'm so sad. Hey, wait right now. Anyway, at the end of the day, if you don't understand, those economics part is not important, because remember, at the end of the day, whether it's a bull market or bear market, it doesn't matter. Okay? Because to be a successful investor is all about what? I mentioned it's all about what? It's all about following your investment plan. So remember, investment decisions of what to buy, when to sell should never be based on economic or market predictions. No. Decisions of what to buy, when to buy, how many shares to buy, and when to sell should always be based on the fundamentals of the underlying businesses. That's the most important point I want to drive across to you guys, right? So let me review this with you. What are the 4 keys to successful investing? I use this acronym WWHW. And if you have not heard this before, please write this down. If you have attended my webinar before, you have heard this 1,000 times. Good. Good review. Okay. So what's the first W? The first W is knowing what to buy. Now again, remember, when you buy a stock, you are not buying a lottery ticket. You're buying part of the business. So what stocks do we want to buy? We only want to buy the fundamentally stronger stocks. So in other words, we only want to buy the highest quality businesses, which is the top one. Which is the top one. The top 1%. So what are the criteria that make a great company? All right, so a quick reminder, right? A great business is one that's able to grow their revenue, net income, and free cash flow consistently for at least the last 5 years. So the last 5 years, you want to make sure revenue is growing, profits are growing, free cash flow is growing consistently. Number 2, a great business is one with a sustainable competitive advantage that protects it from competition, so that competitors cannot easily take away their market share. Competitors cannot easily disrupt their business model. When a company has got this, we call it an economic moat. So an economic moat comes from having a brand monopoly. having high customer switching cost, having barriers to entry, having what's the other one? Having economies of scale. All right. Now, how do you know a company has a sustainable moat? One clue is what we call pricing power. Remember, pricing power. What's pricing power? Pricing power means that when you invest in a business, the business must be able to raise prices consistently above inflation and not lose customers. All right. So as you guys know, one of the reasons why I've never dared to invest in Tesla, for example, especially now, is because it's now so clear Tesla doesn't have pricing power. Because it doesn't have pricing power, it is forced to cut price in order to compete against the Chinese EV makers. And there's so much competition from the legacy auto manufacturers and the Chinese EV players that Elon Musk, in his last conference call, if you listen to the conference call, he said that without trade barriers, he admitted without trade barriers, the Chinese electric vehicles will kill all of us. That is not the sign of a sustainable moat. All right. Same thing with PayPal. Although PayPal looks very cheap, I admit PayPal looks very cheap. PayPal is profitable, but it's not something I would consider high quality because they've got so much competition. They compete against Apple Pay and Grab Pay and Stripe and MasterCard. There's so much competition, right? So you want to buy a business with little or no competition, where the business dominates, they monopolize a certain part of the industry. Like, for example, what's interesting is if you look at the semiconductor market, within the semiconductor market, there are many companies that monopolize a certain niche part of the market. For example, NVIDIA monopolizes what? NVIDIA monopolizes GPUs, graphics processing unit chips, which is needed for AI, right? So NVIDIA has a 90% market share, AMD has a 10% market share. Okay? But when it comes to making the semiconductors, you need a machine, which is this photolithography, which is a machine that's used to print the semiconductor chips. And one company has a 90% market share in that technology, and that's called ASML, right? So the whole idea is you have to buy companies that monopolize, they have more than a 50% market share in a certain part of the market, so that no one else can take their business. You know what I'm saying? Right? So we only want to buy those companies. Okay? Number two is not just what to buy, it is what? Is knowing when to buy. So again, remember, a great business can be a bad investment if you pay too high a price for the shares. If you buy when it's overpriced. But a great business becomes a great investment when you can buy at less than what the shares are worth, when it's undervalued. And are there, now, although many of these great companies have gone up a lot, are there still some of them that are still undervalued? Are there still great companies that are still undervalued? Yes. Amazon is still undervalued. Meta is still undervalued. And there are a few more that are still undervalued. I'll go through them in a while. So hang on with me. Okay? So we only buy great companies when they're undervalued, when they're selling below their intrinsic value and of support. Number three, very important, is to know how many shares to buy. And I talked about it earlier on. No matter how great a company is, do you go all in? You go all into one stock. You go all into Palantir. You go all into Tesla. You go all into Microsoft. Yes or no? No. Why? Because no matter how great a company is, shit can happen that you can't always foresee. So you need to always diversify into minimum 10 to 30 companies. So we call that portfolio diversification. All right? And last is knowing when to sell. So again, some of you ask me, Adam, I bought NVIDIA at $150. Now it's at $600, right? I made how many times my money? Let's see, 600 minus 150 divided by 150. I'm now up 300%. I'm up 4x. Should I sell NVIDIA? Should you sell NVIDIA? Well, it depends. Okay, why do I say it depends? If you need the money for your children's college, if you need the money to renovate your house, yes. So you have got no more savings coming in, and you want to take advantage when the market drops later, sell NVIDIA now. Sell NVIDIA now. Okay? If you hold NVIDIA on margin, it means you borrowed money to buy it and you're up 300-400%, sell it now. But if you don't need the money, right? You don't need the money, as in every year you keep putting in your savings to the market, and you don't need the money for your expenses, and you can just leave the money there, then I'll just leave the money there. So it really depends on your situation. You get the point? Because the whole point is that, in my opinion, will NVIDIA continue to grow and double even more in the long run? I think so. But could it drop in the short term? Yes. You get the point? So it really depends on your own personal situation. But generally, if a company is still a great company, it is still growing, and it is not ridiculously overpriced, I would just hold it. Okay? I only sell an investment if it is ridiculously overpriced by more than 100%, or if I feel that their economic moat is deteriorating. Like in the case of Disney, deteriorating, I'm out. I used to own Boeing, but Boeing, I think their ability has deteriorated. I'm not buying back Boeing. I don't care how cheap Boeing looks, I'm not touching Boeing anymore. You follow what I'm saying? Now, again, like I said, it's all about the individual business. Now, question, guys. Whether I think this year will be bullish or bearish, it doesn't matter. I will still buy good companies if it's at the right price. So, for example, although the market in general was a bit overextended, and I do expect it to drop soon, but I still bought certain companies that I felt were cheap. So, for example, if you're in my UIP my UIP community, where I send you my daily notifications, what I'm buying, what I'm selling, my option trades. So I have been buying LVMUI because I think that this company is cheap, right? This is Louis Vuitton, LVMH. So you can see I added more on the 10th of January at 148, right? So let me show you the stock. Okay, so look at the individual stock pattern, right? Wave up, wave down, wave up, wave down, wave up, wave down. I bought here, right there at 148, which is somewhere here, right? And now yesterday, was it yesterday? Yeah, it jumped to here, and looks like it's going to be going back up here soon. Okay. Now let me zoom in for you. This is the weekly charts. Okay, let me just zoom in to the daily charts. You can see a closer look here. There we are. So in all my stocks, I calculate the intrinsic value. So I know what are the shares worth based on its free cash flow, right? So you can see for LVMUI, my intrinsic value that I calculate at 148 here. Was it undervalued? Yes. So I bought it here, right? In fact, I bought some here as well. I bought here, then I bought here, and now it has get to 167. So now, would I buy more right now? Would I add more now? No, I won't, because right now it's already above my intrinsic value, right? So I just leave it and let it run, okay? And then later, if it gets undervalued again, I just add it again, right? Until I've got a full position. Once I got a full position, I don't add anymore, and I let it grow organically. So that's the discipline. Okay. This is very weird. Give me a second. Hold on. That is very, very weird. Okay, never mind. Okay, never mind. I gotta figure something out. Okay. Okay, let's move on. So let me go to the most exciting part for you guys, which is what sectors and stocks to focus on for this year. Rachel, I don't do private coaching, but I've got coaches that do private coaching. But don't worry. Anyway, now, so in the market, we have got all these sectors, right? We've got technology sector, communication services, consumer cyclical, also known as consumer discretionary, industrial sector, financials, basic materials, real estate, healthcare, energy, consumer defensive, and utilities. So last year, the three best performing sectors were technology, communication services, and consumer discretionary. That was last year. Now, how about this year? Which sectors do I think will outperform this year? First, I think the sectors that will outperform this year are those sectors that will benefit from falling interest rates. Number one. Number two, sector that will benefit from AI. And number three, I think sectors that underperformed last year will outperform this year if their earnings begin to grow. So what are these sectors? Basically, these are the four sectors which I am focusing on. Number one, technology. I think technology will still continue to do well this year and for the foreseeable future. Number two, financials. And I'll explain why more in a while, right? Number three, healthcare. Number four, industrials. Okay, so generally these four sectors. And I'm also watching the small caps closely. Small caps are small companies. Generally, I don't buy small companies. I only buy big companies, right? But right now, I think the small companies are very undervalued relative to the big companies, and I think that they are poised for a rebound. So I'll talk a bit about how I'm exposing myself to that small cap part of the market, right? So let's go into greater detail. Technology. So why do I think technology will continue to do well? Because technology stocks are riding on the AI secular growth trend, and technology stocks will benefit from a PE expansion as interest rates fall. So I showed you this chart before, I believe. Right? So these were all the past cycles. Desktop and internet, web, mobile internet, cloud, and now generative AI. Okay? The global